Research at City, Markets Edition.
Welcome to City at Research Markets Edition, where we break down global macro in 10 minutes or less. I'm your host this week, Adam Pickett, City's macro head in London. We are recording live at 9:30 Eastern on Monday, July 27th, 2026. I am here with my esteemed colleague, Alex Saunders, head of Quant Macro Strategy. Hello, Alex.
Hi, thanks for having me, Adam.
So we put out the House Views theme. In essence, the Middle East conflict has re-escalated, the surge in oil prices, and that's clawed back a decent amount of June's losses. And so when we start with equities, for example, despite the shift in geopolitics, are we still staying risk on in equities, Alex? Or are we trimming? What's the story there?
Yeah, I think as the title suggests, right, we've gone from an era of easy, sort of low risk, high conviction trades, the penalty kicks, to much more macro risks. As you said, we've got this geopolitical cross currents, we also have inflationary concerns with the oil price and AI related concerns in terms of the investment. So that has changed the outlook somewhat, but we're still staying risk on. We maintain an overweight equities standpoint. I'll make a couple of points. The first one is that these cross currents have led us to tactically reduce some equity risk. So earlier in July, we reduced our EM Asia overweight, but the fundamental backdrop is okay. Earnings revisions are strong, albeit those expectations are high, judging by the price reactions post announcements. But when we look at positioning, it's come in quite a bit, actually. And if we look at sentiment, it's not overly bullish. AI, as I mentioned, is front and center. And to recap some of the prior work of you and the team, Adam, which you shale as an analogy, CapEx spending by itself, not necessarily a reason for the market to peak. The market peaks when the fundamentals weaken. Fundamentals in that case were the oil price. Here, the concerns have been around, I would say, open source models. The big picture, we still think that Jevons paradox applies and that there'll be an increase in demand as prices fall. But having said that, the risk is two-way. The closed source models are responsible for a decent amount of the order backlog, so profitability risks there could reduce some of the demand for chips and some of the underlying components. And then there's also regulatory risks.
Super interesting. And so where does that leave us, I guess, on the geography split overall?
Yeah, overweight US. So we maintain that still that's the best place to gain AI exposure, but then we're neutral the rest of the world at the moment.
Interesting. And if you had to drill down into sectors, what do you like, Alex?
Sectors so similar, so we'll keep that tech overweight as well, but also somewhat diversified again into cyclical exposure. So we're trying to stay away from, I think, some of the oil price theme where it's very much two-way risk. So we have an industrials position on as well.
And any risks that we're watching in the big picture?
Yeah, that's a great question, Anima. I think I would highlight that we do have this generals trigger, which really tracks sort of bubbly concerns or concentration risks around bubbles. Technical based signal, it's kind of flirting with trigger levels. So the risk on stance is somewhat fragile. Obviously, we have these geopolitical cross currents. We also have the Fed later this week. So there are caveats, I think, to our view.
Interesting. That's great. And as a reminder for the audience, it's tracking the breadth of the top 7 market cap names in the S&P. How many of them are above or below their 200-day? We started to trigger late last week, and interestingly, if it continues to stay in a negative stance, it would trigger for good the day of the Fed or the day before the Fed. So an interesting setup. I mean, in light of the Fed discussion, I guess I'll turn over to sovereigns.
Sure.
We still keep a neutral stance. What we've kept is our underweight in US rates. I would say that really comes from an RV angle in the sense that in the moment we still think across G10, one of the places that still has domestic endogenous inflation and growth risks is the US. And to some degree, if we are to take away the Iran risk or move beyond peak Iran risk, which, some of the headlines over the weekend maybe suggest we're getting close to, we think the rally or the reprieve in ex-US duration could be stronger, given most of the inflation concerns there are external. And we've mostly been playing that in European duration. We were previously overweight gilts, but we decided to change that up and move gilt back to neutral and go overweight bunds instead. And ultimately, we think gilts are more sensitive to global energy spikes. We see that from our analysis, as well as some local fiscal vulnerabilities rearing their head again as well.
On that, Adam Burnham, I think, has given some interviews. We now have a cabinet out there as well. What's your initial take on the political backdrop?
Yeah, it's still pretty light on detail, I must say. There's obviously the intent to work within the fiscal rules, although I think the key push on the idea of trying to find as much flexibility as possible within those rules maybe slightly spooked the market on the margin. We've seen a little bit of sort of cross-market curve steepening in the back end, 10s, 30s in the UK, sort of relative to European peers, which maybe suggests just a hint of a fiscal worry. But for now, we're still in wait and see mode. But ultimately, we just think bunds are a cleaner, safer haven to kind of capture maybe some of those Iran risks eventually coming away.
And then JGBs have been selling off. We were underweight, but that was brought back to neutral. Can you talk about that a little bit?
Absolutely. We cut our underweight in JGBs more on the kind of the sentiment around some of these announcements, hinting about shifts in flows both from the GPIF and NISA accounts, trying to sort of push money back into JGBs. In our discretionary portfolio, we moved the underweight back to neutral and in effect sort of targeted the front end pricing more. So our view is that there's just more juice in playing for a hawkish BOJ rather than to be outright underweight duration. So we're neutral in the asset allocation just because we think the long end's got a bit more noise around it. But ultimately, we're from a sort of existential view, we still think the BOJ is slightly underpriced. I think we've done a good job of covering fixed income in the sovereign space. But Alex, what about credit? And how are we thinking about credit in the context of our asset allocation?
Yeah, credit. I mean, we're underweight in the US and in Europe, investment grade, and it's been a sort of relatively long-standing view to have this underweight, and we've been tactical around it on and off. But the basic premise is really that in risk-off environments, on a risk-adjusted basis, credit typically underperforms, and therefore the credit underweight is not really a view on the asset class per se. It's much more of a hedge for, I would say, the portfolio's active risk. Spreads are not particularly wide as well. So in terms of the cheapness or expensiveness of that hedge, call it, it's not that unattractive. I would say that my regime work also shows that financial condition tightening it almost always precedes or is at least contemporaneous with some of the less benign macro backdrops that you have for risk assets. So stagflation, we see periodically concerns pop up. That typically nearly always happens with the financial conditions tightening. Credit spreads are a pretty important element of that tightening. And then the final point I would say at the moment is the supply pressure. So from a fundamental perspective, we've seen like a decent volume of new IG issuance that has weighed on spreads a little bit. It has increased the weighting of AI related risk in some of the credit indices, and our credit team has done a great job in terms of quantifying that. And in terms of that AI, we think that the risk reward basis for AI accrues much more to equities than it will do to the credit. So we think of the view as a technical basis. So we think of the underweight as has this technical basis from the supply overhang, but also it acts as a decent risk hedge. So if we finish off, Adam, the portfolio run with our commodities and our dollar view, we're overweight commodities, but neutral on oil. Can you comment on that?
Yeah, absolutely. Energy, I think, is really just far too up in the air right now, just given the negotiations between the US and Iran and even kind of structural OPEC dynamics beyond that. Instead, our higher conviction is in base metals. We still see this as a reasonably strong cyclical global backdrop. And in particular, copper has been incredibly resilient to the backdrop in geopolitical tensions, which we see as a net positive. There are some structural EV transition and AI tailwinds for that space as well. So we like it there. Neutral gold, just because pretty large pullbacks, but a real rates picture that is still looking quite perky. So not clear to us that it's the all clear there on gold. And in FX, we moved neutral on the dollar in the middle of July, right after the soft CPI print. And ultimately, when we look at our Eureka framework, our model for euro dollar, relative rates, relative equities, relative terms of trade, and relative data momentum, it's really only relative equities that are in favor of euro. So it's a mild dollar bullish, let's call it signal from the model. But a lot of those crossovers or signals are super close to being flipped. And so obviously with US Iran and with the Fed ahead being such big catalysts, that model is liable to jump about a bit, which I think is a good way of sort of wrapping up a lot of investor sentiment around FX at the moment. A lot of the signals are sort of balancing on a knife edge and it's difficult to take too strong a stance. Instead, we're hiding out in FX carry, but in currencies that also benefit from higher energy prices within that carry basket. So that wraps it all up. As a quick high-speed summary, we're overweight equities primarily out of the US, and we like tech and industrials and sectors. Within commods, we like base metals, but are neutral everywhere else. We're underweight IG credit, neutral on rates with a bias towards underweight treasuries versus boons. Citi clients can access the full report on velocity. Reach out if you'd like to see more of it. The macro team will be back in 2 weeks, and we look forward to speaking to you.
This podcast contains thematic content and is not intended to be investment research, nor does it constitute financial, economic, legal, tax, or accounting advice. This podcast is provided for information purposes only and does not constitute an offer or solicitation to purchase or sell any financial instruments. The contents of this podcast are not based on your individual circumstances and should not be relied upon as an assessment of suitability for you of a particular product, security, or transaction. The information in this podcast is based on generally available information, and although obtained from sources believed by Citi to be reliable, its accuracy and completeness are not guaranteed. Past performance is not a guarantee or indication of future results. This podcast may not be copied or distributed, in whole or in part, without the express written consent of Citi. Copyright 2026 Citigroup Global Markets, Inc. Member SIPC. All rights reserved. Citi and Citi and Arc Design are trademarks and service marks of Citigroup Inc. or its affiliates and are used and registered throughout the world.